Congratulations for taking a little time out of your busy schedule to educate yourself on our most popular and highest demand educational seminar that we do around the country and through the webinar. This is Levi Clock, the founder and principal of Clockwork Financial, and we have been serving entrepreneurs for over 14 years now. And we are always looking for the safest and the best ways to operate our money and to do what the major banks and corporations do with their money and don't teach. So we are definitely excited to share this with those of you who are open-minded enough to look at it and educate yourself and make a decision for what's best for you and your family and your business. A majority of our clients are very creative entrepreneurs wanting to look for ways to reduce their risk, increase their returns, and implement some financial strategies alternative to what the mainstream is doing, because obviously based upon results, the mainstream financial world is not doing so hot, especially today. Most of our clients have a fee-based relationship with us. They hire our firm to help look at their whole financial picture, analyze where they're at, where they're wanting to go, and with our team of experts from attorneys to CPAs, insurance professionals, investment professionals, mortgage bankers, brokers, coaches, doctors, credit repair, just about every type of professional that you would need to help grow your business and increase your peace of mind. We have identified some of the top experts to come and support our clients. Now, we do these educational webinars every other week on Fridays at 11 a.m. Central Time, and we try to keep them about 30 to 60 minutes long. We know that people get busy, and for those who want to grab a bite to eat for lunch and educate themselves in the process, we invite you to inquire about our upcoming schedule on our website, clockworkfinancial.com. For those of our local participants, clients and prospective clients, we do monthly educational seminars teaching you how to become your own banker. That's also on our website. Again, I'm Levi Clock. Got started in the business about 14 years ago and trying to figure out how to improve my own personal financial life and my beliefs and habits with money. And in the process, have read many books, attended many educational events and seminars, and had coaches, mentors, and have been very blessed to be educated by some people a lot smarter than me and a lot more experienced as well. So I am a product of just remaining teachable and a student of continued progress and growth in my life. For many years, I worked specifically with pre-retirees and retirees, and have received my certified senior advisor certificate, as well as certificate in financial planning, to have a comprehensive education and understanding in the financial world. Here's a picture of my family. My beautiful wife, Chantel, is RN, and she stays home with the kids now. We've got 6 and 7-year-old Jasmine and Jaden. And, historically, financial success has come generation to generation, to where the reason there's 3 distinct social classes, the elite, the middle class, and the poor, is because habits are passed down generation to generation. Especially when we talk about the topic of becoming your own banker. Now, how many of you have actually attended a class in school or higher education where someone actually taught you how to develop your own financing system for your business or for your family or for both? That is typically reserved for individuals who have obtained a great amount of wealth and have figured out how to get into the banking and financing business. And it is a very, very profitable business. Therefore, it's something to take a serious look at for yourself to see if this could apply to you. Now, about a decade ago, I was doing some financial planning for at the time, my girlfriend's family, who then became my wife. But I looked through their insurance and financial papers and pulled out a book that kind of made me double take because I'd never heard about this book, Becoming Your Own Banker. And I asked them what it was about, and they said, well, we don't know, we haven't read it yet, but our financial planner keeps telling us that we should really read this book. So I said, well, can I borrow that book, because I'm interested in learning about it. And a few hours later, I got through the book and was really just amazed at a different perspective on looking at insurance and banking and how I can change the habits and beliefs that I have about money. Warren Buffett said if poor people would just do what rich people do, they wouldn't be poor anymore. How about that for profound wisdom? So what do the rich people do? Well, we'll talk about that. It's not just about obtaining wealth and money, though. I like Jim Carrey's quote here that he says, I wish everybody could get rich and famous and everything that they dreamed of, so that they can see that that's not the answer. So accumulating financial success is just one part of life, but it's not the answer. So rich people, what do? Well, they think like a bank and act like a bank, and that way they don't give all their money to other people's banks. So isn't it time that you start to look with that perspective as well, like I've learned to do? Now, let's look at one of the problems in our financial world that we live in. Of course, we have a car, if not multiple cars. We've got a house, if not multiple houses. And we have our living expenses and our lifestyle. All the while, we're trying to save money at the end of the month and put that in the best place that we can. Oftentimes, we're guessing and trying to figure out how to grow that money. We're accepting extremely low interest rates because of our lack of understanding of the options out there. But if we take away the expenses on our key areas here, and we look at how much does it actually cost us in financing dollars to finance our lifestyle. Now, the average savings rate in America right now is actually about 3.94%. Before this Great Recession, it was actually negative. People were spending more money than they made, but on average, as a nation of individuals, we're starting to save again, which is like Finance 101, save some money. And if we look at the cost of financing our lifestyle, it's about 34.5 cents on every dollar we spend will go to some banking institution for our cars, our housing expense, and our living expenses, and financing these things. So my question is, how do we get ahead when we're trying to move forward at 10% and we're moving backwards at 34.5%? And you definitely need to get the book Becoming Your Own Banker if you don't have it already, and if you haven't read it a couple times, it's a must read. But Mr. Nash illustrates in the book, being an airplane pilot, that it's a lot like flying into a headwind. You know, if you move the decimal point over one position, the 10% turns into 100, and he calls it 100 miles an hour. If the 34.5 cents move the decimal over 1 point, and it becomes 345 miles per hour. So how can an airplane fly into a headwind at 100 miles an hour moving forward, and the headwind is pushing him backwards at 345 miles an hour? Can you see the problem? Can you see the problem with your own financial life? If you're borrowing money and financing these things and not saving more than you are spending on financing, it's very difficult to get ahead. So we'll address over the next few slides here of this seminar how to address this problem of interest. Now, everything that we purchase is financed, even things that we pay cash for. That's a method of financing. We're giving up opportunity cost on those dollars, which is what that money could have been earning for us if it hadn't been depleted. Now, how much profit do you actually receive from the financing entities that you use to help finance cars, investments, real estate, business equipment, and so forth? Well, most people that we talk to, that number is zero. Now, the real issue of concern here is not necessarily the rate at which those dollars leave our financial world, but the volume of dollars. In other words, if we look at financing a mortgage over 30 years, over 80 cents on the dollar will go to a bank to finance that home for you. So that's a lot of money. That's 80% of every dollar. That's the volume of money, not the rate, which may be 3, 4, 5, 6% in this economy. Okay, so we're going to address those volume of dollars. Now, if we want to start recapturing those dollars, we've got a couple options. We can go the traditional route, which is start our own chartered bank, such as a Bank of America, Chase, Wells Fargo type of a traditional bank. But to get into that game, you need $20 million of capital stock stored at someone else's bank until you can stand in line, go through the paperwork, jump through the hoops with the banking commissioner for him to approve you and grant you a charter to start your own bank. Now, before you can even get into the business, you've got $20 million at somebody else's bank earning about zero. And you can't do a single loan, which is your product to sell, until you convince depositors to put money in your new bank when there's all these existing banks floating around to choose from. Now, in most major cities, there's a bank on just about every street corner in America, and the world for that matter. So obviously, they must be doing something right. It must be a very profitable business to get into to have such a high saturation with banks. So how does that work? How do they lend money out and collect these deposits? Well, a bank, for every $1,000 of deposits, guess how much they can lend out if that deposit is put into their Tier 1 assets, which is the money that they can actually leverage and lend out to their borrowers. Well, if that money is put into one of 4 asset classes, which is cash, treasury bills, precious metals, or cash value life insurance, a bank can lend out on average at least 10 times the deposits they have in their Tier 1 assets. So $1,000 going in, $10,000 going out. So my question to you is, if they've got that $1,000 in their Tier 1 assets, where did the $10,000 come from that was lent out? And our most common answer to that question is from other depositors. Well, that's not the case. It's actually, it comes out of thin air. The banks can do what's called the money multiplier and lend out money that actually is not on their books and it doesn't exist anywhere. It's fancy accounting, which is why banks have to purchase FDIC insurance to cover that gap and that risk of lending out money that doesn't actually exist. So here's a scenario. Say you've got $100,000, you go to a bank, which it doesn't matter which bank it is, they're all connected to each other through the Federal Reserve banking system. They're all members of a larger pool of banking entities. But your $100,000 goes into the bank, and if you're extremely lucky in this interest rate climate, you'll get 2% on that CD. They'll take that $100,000, purchase Tier 1 assets, cash, treasury bills, precious metals, or cash value life insurance, and the next person in line wants to buy a house, so they'll lend up to $1 million backed by your money, inflated and creating money out of thin air, and they'll lend money at a higher interest rate and make money as well on that spread. Now, when you purchase the house from the seller doesn't just sit on that money under their mattress. They'll put that back into the system for the next person in line to finance a car, say 8%. Well, the dealer doesn't sit on that money in the vault at the dealership. He'll put that into some banking system, and they'll lend that back out for house remodels at a higher interest rate. Contractor puts the money into the system. We consolidate debt at a higher interest rate, and credit card companies will put that money back into the system, keeping the money moving and flowing, and somebody's making a spread off of each of these transactions. Is that you or is that your bank? Well, if we look at that spread, 7 minus 2 is 5%, 8 minus 2 is 6%. On the house remodel, 7% spread, and on the high interest debt consolidation, there's a 10% spread. Now, how much more interest is the bank making than you are? Well, our most common answer is 26%, because 28 minus 2 is 26%. But isn't 28 14 times more than 2%? Okay, so the bank isn't just making 26% spread, they're making 1,400% more off of your money than you are. What's their risk? Well, pretty minimal, considering that CD is there in their pocket, and then each loan that they lend out is backed by a real asset and real collateral that protects them as well. So banks are typically the last ones in and the first ones out, minimizing their risk, pocketing the spread, the difference. And these transactions don't just happen once a year, by the way. Wouldn't they happen at least monthly or weekly or maybe daily? When's the last time that you got a offer in the mail for a credit card? Okay, banks are begging you to borrow money from them if you qualify, according to their standards, because they make money when they sell their product, which is loans. So my question is, how much money are you making off of your loans? Well, here's an interesting quote from somebody who understands banking. Sir Josiah Stamp, president of the Bank of England in 1928 to 1938, which is where the U.S. got our idea for the central banking system. So they operate very, very similarly. But Sir Josiah Stamp says that the modern banking system manufactures money out of nothing. The process is perhaps the most astounding sleight of hand that was ever invented. Banking was conceived in iniquity and born in sin. Bankers own the earth. Take it away from them, but leave them the power to create money and control credit, and with the flick of a pen, they'll create enough money to buy it back again. Take this great power away from the bankers, and all great fortunes like mine will disappear. And they ought to disappear, for this world would be a happier world to live in. But if you want to continue the slaves of bankers and pay the cost of your own slavery, let them continue to create money and control credit. Okay, now, Sir Josiah Stamp, I think, understood the ins and outs of this system, so we can't argue with him about how the banking system works. Do you really want to go through that process in order to control your banking needs? Well, there is a much simpler way, and it's leveraging a financial vehicle that's over 200 years old that all the major banks and corporations use, and it's a financial instrument through the insurance industry called dividend-paying life insurance, cash value life insurance. And we prefer to use mutual insurance companies, not mutual funds. Those are different. Mutual insurance companies, because they are in business for their policy owners. They don't have any stockholders or shareholders. They're actually owned by the policy owners. Now, there's a lot of different ways that we could put our reserves and our savings and investments in different accounts, and some of them we could borrow against for our financing needs, and others we can't. But I challenge you to take the test yourself. Find out, where is your money? Where are you trying to grow your money and save your money and protect it? Well, we've interviewed 1,000 entrepreneurs, and we've asked them, what is it exactly that you want your money to do for you? What's your criteria for determining what you're going to put your money into? So we've created a list here on the left of, these are the benefits. These are what entrepreneurs want, investors. On the top, these are some different strategies and sectors and asset classes that we can divvy money up into. And I challenge you just to take the test yourself. Check mark if your money has a competitive return or if it's a minimal return. If you're in CDs, for example, at 1% and inflation is 4 or 5% or more, how much money are you actually making when your dollar's worth 5% less next year and you only went up 1% or 2% or 3%? Does it have a guaranteed return? Is it 100% insured? Is it growing tax deferred to give you control of when you pay taxes on your gains or not? Do you still have liquidity, use, and control of that money, or is it locked up for a long period of time? Can you make unlimited contributions, or does the IRS or the government say that you can only put so much money into that asset class, such as IRAs, 401ks, Roths? Are you guaranteed to get a retirement income from that asset? Is it tax-free income? Are you going to leave a tax-free legacy to the family that blossoms and a benefit that becomes multiple times more than the cash account in your investments or retirement accounts? Is it sustainable for life? Is it judgment proof and creditor proof if somebody sues you or creditors come after you? Does your investment company or insurance company continue to make your monthly savings and investment amounts if you're disabled and unable to work? And lastly, do you have the ability to bank off of this money, which simply means the ability to collateralize your asset and let that money grow for you while you take a loan against it and finance what you're going to need to purchase in-house instead of through banking entities that you don't own a piece of the profits? So the CP here is what we call Clockwork policies, and this is implementing Nelson Nash's book, Becoming Your Own Banker, the infinite banking concept. And we are students of his, friends of his, have done seminars together with him, and have the greatest level of respect for his research and the ability to teach banking through a much easier and straightforward strategy in the insurance industry. Now, if Tiger Woods knocked on your door today and said, "Hey, I've got an offer for you. Would you like to buy my clubs or pay me a fee to learn how to swing a club? And I'll teach you my swing." Well, we ask that question when we do our seminars around the country, and most people would say, "I'd rather take some lessons and learn the process. I'd learn how to swing those clubs instead of just buy the magic club." Or in this example, buy the magic investment or the next hot stock tip, or roll the dice trying to pick the right mutual fund or something. So what we teach is the process of money, moving money. I believe there's a universal law that says in order for things to be alive and healthy, they have to be moving. Stagnant water, for example, in nature, it becomes poison. You can't drink it. If oxygen or blood stop flowing through our body, we're dead. If money in an economy stops moving and changing hands, then an economy dies. And that's true even more so with our personal economies. Are we collecting money and just sitting on it? Or are we learning what the banks and corporations learn, which is keep that money moving and make a profit off of each transaction, operate off of velocity instead of just compounding of interest? So insurance companies, and again, we have select mutual insurance companies that have the highest ratings and the best history and experience of developing these types of policies to keep reserves safe, efficient, and tax-free. And insurance companies are really just depositories. They collect money and they move money. Banks call these deposits deposits. Insurance companies call these deposits premiums. So they create a money pool within the company, and they're looking for ways to flow that money through their money pool and do loans and loan repayments through joint ventures, mortgages, policy owner loans. And every time that a loan is done through this money pool, a profit is made, the money pool expands, and with a stock company, those profits are declared as dividends to the shareholders. With a mutual insurance company, if we take the shareholders out of the equation, then these profits go to the policy owners, which also outrank everybody else with access to this money pool when they need to borrow money and finance something. Now, of course, with all these policy owners using life insurance, somebody's going to die, and most years, many people will die. Well, they've got the reserves backed by the highest grade government and corporate bonds, and they're able to also have reinsurance companies, which are insurance companies that protect insurance companies. And there's state insurance funds as well. So each state that these insurance policies are written in have their own state guarantee fund to protect the policy owners. So to my knowledge, I've never seen a single policy owner with one of these types of policies with a mutual insurance company that's ever lost $1 in these policies. We can't say that about other industries. So these death claims, they do come out of the money pool. They affect the bottom line as well as the operation and expense of running the company. But everything else is left as profits. And again, these mutual insurance companies pay out the dividends not to people who own term insurance, not to people who own health insurance or disability or critical illness or long-term care insurance, but the people who own these dividend-paying mutual life insurance policies, and they reinvest these dividends in more deposits, or called premiums, with insurance companies, expanding the company's money pool and your personal money pool within your personal policy. So instead of spending those profits, we reinvest those in a tax-free basis, growing our triple compounding money pool of interest, dividends, and the interest on the tax savings as well. So here's Mr. Nash's first policy that he invested in 1959. He was 28 years old. He was only doing about $388 a year, and he didn't have the paid up additions rider attached to this policy to really maximize the growth and the cash in the policy, and he wasn't maximizing borrowing and leveraging this asset as well, but just simply funding it and letting it grow, which is a very, very conservative projection here of how to grow these policies. And here's the historicals. Here's what it actually did. Again, this is an old policy, putting a tiny amount of money into. In 1990, which we're looking here at, 30 years later, 31 years later. The money in green here is the premium. So this money is his annual deposits into his policy. It never goes up. It never goes down. It's locked in. And that alone makes these permanent cash value policies, the whole life policies, unique to other types of life insurance. It's the only one that's guaranteed never to go up and never to go down. The money in yellow here is what we call the guaranteed cash value increase, which today most of these insurance companies have a 4% guaranteed tax-free return on the cash value inside of these policies. So a taxable equivalent would be somewhere around 6-7% guaranteed every year on safe money. And then, of course, the annual dividend is this policy's share in the company profits. And in 1990, he paid his little $388 deposit as premium, increased about $400 guaranteed, and his share in the company profits was about $2,000 in that year. So this policy continues to grow year after year after year. Every year, these dividends were paid out into the policy, creating a super compounding growth inside of these policies. Now, as Mr. Nash traveled around the world, a lot of people didn't believe that life insurance would pay such high dividends and profits. So he called up one of his insurance policy companies. This one particularly was with State Farm. And he said, okay, for the next 3 years, instead of reinvesting that dividend into my policy, I want you to pay me a dividend check so that I can actually make a copy and document how much profits I'm getting from a tiny little policy. And in 2006, you see, he paid his $388 premium, and he received a $3,800 dividend check, income tax-free, from State Farm. 2007, paid his $388, received $3,927 in return. 2008, paid his $388, received $3,900. Now, $388, we don't even do policies that small anymore, but what if he was paying $3,800 every year? This dividend check would be 10 times this. It would be $38,000 a year, income tax-free, in his share of this one policy's profits. We have clients putting over $38,000 a year into these policies. This would be a $387,000 income tax-free dividend from this policy if he was putting in $38,000 a year instead of $388 a year. So at the time Mr. Nash came into town last, I had him do a seminar with us. He had 44 policies at the time, but this is just one of them. And as he talks about in his book, in the chapter called Expanding the System to Accommodate All Income, You'll want to study that as well as every other chapter in the book to see how you can expand the returns on your deposits in your banking system. So here's your all-American man just putting a little amount of money into the money pool, $50 a month into the insurance company, and complaining about it. All the while going outside of his assets to what we call the Great Wall of China, paying gatekeepers and toll takers for financing help, companies like General Motors Acceptance Corporation or an automotive banking entity, like they've all started creating their own banks. And this all-American family's given $260 a month to their car financing company and bragging about it. Now, does GMAC finance this for free, or do they charge a spread? In this example, it's going to be about $30 a month on average that the financing company pockets, and they pay back the money pool $230 a month, which is the exact same money pool that collected your $50 premium, and you went outside of that money pool to finance your cars. Now, remember all that interest that we talked about earlier, that 34.5 cents on every dollar to the banking institutions? That's where it comes from, that little $30 here and there every month over the course of your lifetime. So how do we fix that problem? How do we plug that hole in our financial bucket? Well, what we do is reverse the polarity. Instead of putting tiny amounts of money into the money pool and large amounts of money into the credit card companies, mortgage companies, and auto financing companies and school loan companies, we take the same cash flow, but we deposit it into premiums. Remember, that's deposits into an insurance pool. After a few years, we'll have that $10,000 that we needed to finance that car, and instead of liquidating that money and starting all over again, as your classic sinking fund strategy would look like, we borrow against the cash value in the life insurance policy at the insurance company, and we get the $10,000 at this current interest rate environment. They'll charge us around 5% or less for that money. Well, over time, we're making more than 5% on the money in here, so it's what we call a wash loan. And instead of giving the finance company all of that cash flow, we pay it back to the money pool that we borrowed it from. Instead of giving them a minimum $260 a month that we'd give another bank, we increase the interest rate that we put back into this money pool, a small amount, which forces us to grow our money pool, our banking system, the insurance company that we're a small owner in as a mutual insurance owned company. So over time, you see here that it becomes very profitable to do this as we analyze the 5 ways that are most common that people drive cars. We lease them. Well, that's the most expensive way to do it. We finance it through a traditional bank or automotive financing company like a Ford Motor would finance through Ford Credit. And that's a little bit better than leasing, but still not as good as cash. Well, most financial gurus will stop the conversation if you can get out of debt and pay cash for everything. Well, short term, cash is the best method. But are we in life for a sprint or a marathon? Are we just looking at the next 3, 4, 5 years? Or are we interested, even if we're in our 70s and mid-70s and 80s? Is there still a chance that we can live 10 years, 15 years, 20 years? So we're never too old to do something better for the long term, especially when it comes to becoming your own banker, because using life insurance, if we live a long time, that gives the cash value and loan repayments time to compound more efficiently. If we don't live a long time, then guess what? Your death benefit blossoms into multiple times more money than you ever could put in there, and it pays out income tax-free to the ones you love the most, who would ultimately receive your heir in your estate. So let's take a look at the 2 profitable ways to finance automobiles over a long period of time. 44 years, just financing a $10,000 car every 4 years. Now, the CD method is more profitable than cash, and we are actually purchasing certificates of deposit at a bank and borrowing against that CD and paying that bank back. Now, we don't have time in this webinar to go through the year-by-year detail, but turn to page 41 through 46 in the book, Becoming Your Own Banker, and he walks through the math, showing you how you'll have about $200,000 in cash in a bank CD by borrowing against the CD. Now, the interest rate is extremely low on the CDs right now, as well as being taxed, as well as the bank. Will they share their profits with you at the end of the year or the end of the quarter? Not usually. So, if we want to look at the long-term best way to finance cars over the rest of our lifetime, we've got to be honest and look at how do we finance against our life insurance. Now, most people have some life insurance. We're not anti-term insurance, but as far as financing, not just buying insurance or saving money, if we look at how we finance things, using a permanent policy, especially with a mutual company that will share their profits with you, the infinite banking concept will have over $900,000 in cash in a life insurance policy by financing the same ins and outs that you did through borrowing a CD or saving up and liquidating to pay cash. So take an honest look at that. Don't just take us for our word for it. Read the book at least a couple times. Open your mind to looking at how the major banks and corporations are doing financing. And what you'll find if you look at their books is many of them have millions, if not billions of dollars in these types of policies. Here's page 45 in the book. We're not going to go over this in great detail, but I do want you to look at the 4 phases of banking. First phase is the capitalization, depositing money into a banking system, getting money in there. The next phase is the loans, the ins and outs of that money, which is the rest of our life for the most part. We're going to be financing things. In this book, he just compares the method D from method E, which is borrowing against a CD or borrowing against life insurance structured this way. The third phase of banking is what we call passive income. Many call that retirement income. I don't like that term because during our most experienced years of learning what we've learned in our lifetime, we should continue to do what we enjoy. And especially if we can have a business doing what we enjoy, then we'll continue to make money throughout the rest of our life to live off of. But if we want to supplement that income from draining a CD with $50,000 a year, you can see here in this example, 5.5 years completely running out of money in a bank CD. Whereas the life insurance policy, taking the same $50,000 a year out, the cash value continues to grow. You never run out of money. This income, if done the way that we teach properly, it's not taxed on your income. The fourth phase and the final phase of this banking process is legacy transfer. Now, in the industry, they call these death benefits. I haven't met anybody that got real excited about death benefits, but most people want to get their ducks in a row and leave their family and loved ones and charities a legacy. So we call this final phase legacy transfer. So we take the total death benefit minus the loans against the policy. So we still have over $600,000 left over to leave the family from this one policy. Now, what if you have 2 policies? What if you have 3, 4, 20, 40? You can see how as your financial situation gets better, you can expand the system to have more long-term wealth, minimal taxes, and a maximum amount of legacy transfer to the ones that you love most. And then we also work with attorneys to structure this in a way to make this legacy last intergenerationally, and how to set up dreams and goals and accomplish these things through a system that is tried and true and proven. Now, there's a lot of places we can keep these reserves, but no other place on that comparison chart that we showed earlier has every single one of these benefits. So look into that yourself. Look into where the banks are putting their Tier 1 assets, as we talked about earlier. They're required to put it into either cash, treasury bills, precious metals, or cash value life insurance. The major banks, Bank of America, for example, in 2009, over $18 billion in these cash value accounts. Of course, that was a few years back, but they've got well over $20 billion in these policies here. If it's good enough for the banks, it's good enough for me. Now, we do work with entrepreneurs. We do teach business owners how to get into the banking business. That's one of our areas of expertise. You can see here that every car dealership, car manufacturer has caught on to the trend. And by looking at Ford Motor Company's financial statements in 2005, 6, and 7, you can see here that they've got two businesses, automotive sector and the financing sector. Selling cars, they wrote off 3.8, and this is in millions, so 3,800 millions would be $3.8 billion. All the while, their bank made $4.9 billion profit. $17 billion write-off selling cars, $1.9 billion profit financing them. $4.9 billion write-off in 07, $1.2 billion financing them. So if you're not wondering how to get into the banking business at this point, we're probably talking to the wrong person. But if you're interested in wanting to learn how to finance your business's products and services, we will show you how to do that, show you how to put your reserves into accounts where you're getting competitive returns, guaranteed, insured, tax deferred, still giving you liquidity, use, and control of your money. In theory, unlimited contributions. There's some ways that we talked through that. Generating a long-term passive income, tax-free, sustainable, judgment-proof and creditor-proof for your money. If you're not over 60 years old, then we can have disability waivers with most of our companies that we use. Tax-free, income tax-free legacies, and the ability to bank off of this money. So continue to invest in your education, continue to buy books, read books, go to seminars, educate yourself, sign up for one of our upcoming seminars and webinars, ask us what books that we recommend that you read next, request your free consultation. Our consultations cost us a lot, but they don't cost you anything until you make a commitment to work with us as a team approach. There's no obligation. There's no charge for attending our webinars. And check out our new website, clockworkfinancial.com. We're continuing to grow and add resources and develop that site to make that valuable for you. But ultimately, the most value comes from making a commitment to strategize and work on a financial game plan with experts who've been down this road many times. Get your copy of Becoming Your Own Banker. You can request that from our office or our website. Also, How Privatized Banking Really Works, integrating Austrian economics with infinite banking concept, and Mr. Nash's new book, Warehouse of Wealth. So these are typically about $25 a piece. You can get all three of them shipped out same day from us for $60. We can invoice you, and we just want you to get educated, because if you understand what's going on, then you'll know what to do. Appreciate your time. Thanks a lot. We hope to work with those of you who are open-minded to learn how this can benefit you, and we will look forward to talking to you soon. Have a blessed day.